Hello again, everyone, and welcome to Index Options for Income. My name is Mark Fenton, and just to revisit, I don't think I've mentioned it for a few videos, I am a options trading mentor with SheridanMentoring.com, and I have been one since 2007, about 15 years ago now. And today, I want to talk about diagonals. If you remember the last video, we did calendars. Now, diagonals, we often say, are the calendar's cousin, because they also involve selling an option in a nearer term expiration and buying one in a further out expiration and trying to take advantage of that disparity in time decay pace. So let me get started by sharing my screen. And once again, we'll be looking at the TD Ameritrade Analyze page, which is where I live as a trader, so I can look at my trades before I ever place them and see what they're going to look like. Now here on the screen, and I'll go through the components, we have a diagonal. Now, one thing that you'll notice about this diagonal that makes it look different than a calendar, they do look similar, but this diagonal doesn't have any downside risk for quite some time. So needless to say, this would be a trade that you'd want to do if you were at least more concerned about a downside move than an upside move. As you can see here, it can trade around the same place. It can go up a little and we can still make money. It can go down. Remember, we want to stay inside of our graph, and it can go down a long way and we're fine. So if you wake up one morning and that big down move happens, it won't be near as scary for you. But let's look at the components again of this trade. So for a diagonal spread, which I only start as a put diagonal, and the reason for that is, once again, the diagonal is long vega, just like the calendar. Well, remember I said that volatility tends to go down when the market goes up. So if I was worried about the market going up, I probably wouldn't want on a diagonal, even if it was a call diagonal, because I'm going to lose money on volatility if the market goes up and the VIX, as usual, would go down. So this is a trade you would only really want to place whenever you're at least more concerned about the downside than you are the upside. But once again, in this trade, I've gone out here, and what I do in a put diagonal is I usually go a little above where we're trading, maybe 10, 15, 20 points, and I'll sell that option and buy a long above it. So if we look at this, we're trading at 40.79 here in the SPX. So I went to 40.90 on the 6th, and then I sold the March 3rd 40.80. So it looks like this. So my long is what you would say deeper in the money than the short is. So as this goes down, my long, of course, is gaining value, even though the short's working against it. But that long is really protecting me on the downside because it's 10 points further into the money than the short is. And as you can see here, this cost about $7.55 or $755 in options language. Remember, an options contract is 100 shares. So everything you see is times 100. So if you see $7.65, that actually means this trade would cost you $700 or $765. And that really comes down to the difference between what you sold the March 3rd and its value and what you bought the March 6th, which of course would have more value because why? It's further out in time. The further out in time an option is, the more time value it has. Now you can make these different widths. I've just done this 3 days wide, but the principle's the same. If you go out further, you can see, watch this theta number, $44.57 for the 6th. What if I go out and instead I bought the 7th? It's $43. Let's go on out to the 8th. It's $50. So there's a little bit of disparity between the 7th and the 8th, but you can see when I went out further, like the 8th and the 3rd, which would be okay to do, a couple of things happen. I make more money on theta. Also, the price goes up, and also it doesn't look quite as groovy, you might say, here on the downside, does it? As it does with the 6th, where it looks like I have a lot more downside room. So this is a very useful trade to use if you're in an environment where maybe the market's really kind of brittle, you're afraid of that downside move, you It's a lower volatility environment. Once again, we probably want the VIX to be below 20 for best results with this trade. Could you do it above 20? You could, because let's face it, if we're right and the market does go down, the long volatility will help us. So you're not so much worried about volatility in this trade as long as it doesn't go up a lot. But you can also see you'd also have a little bit of a price movement problem on the upside also, and you'd have to make an intervention to repair the trade sooner, whereas you have a lot of room here on the downside. Now, I'll get into repairs of different trades in future videos, but what I wanted to do here today, and all the previous videos I've already done here, is to just introduce you to basic concepts in option spread trading in an index. That way, whenever I refer to a diagonal, you'll go, oh, okay, that's what Mark's talking about. Or you could go back and check this video, or maybe Mark mentions a calendar. You go, oh, yeah, that's right. That's what this is. Or a vertical. Oh, that's what this is. At least you know when I'm using a certain term, what I'm referring to, the basics of it, how it's set up. Where are the strikes? Are they in the same expiration? Are they in different expirations? Are they long vega? Are they short vega? And you'll find over time that so much of the way I trade options involves volatility and trying to take advantage of it, and or trying to not be damaged by it as best we can by trying to do trades that give us the best chance of success. So I hope you've enjoyed today's video. This is another nice strategy that you'll want to have in your portfolio for income trading. You can also use this one for speculative trading because it is very directional in its nature. And I'm going to be back next time. I think you're going to find it exciting, and I'm going to talk about a double diagonal where we have one of these on each side, and we'll talk about how that's set up and why we might do it. Have a great day, folks. Thanks for being here. And don't forget to like and subscribe to all the videos. Thank you.